Corporate finance practice problem using OneNote. Expected value and coefficient of variation investment options. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, down in the 1328 Expected Value and Coefficient of Variation Investment Options tab. Also note, when using OneNote, take a look at our immersive reader tool. Many of the presentations up top will be mirrored down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, going through the calculations on down below. We're going to imagine we have two basic investment type of options that we're going to be comparing on a side-by-side basis, using the same kind of statistical type of analysis that we're trying to project into the future and put our thought process in as best a way to do so as possible. And that means that we're going to be categorizing for each investment what we think the returns would be if it was, in this case, what do we have, 5 categories. You don't really need the names for the categories on the left-hand side. You need basically the numbers here, but sometimes it's useful to have the names of not good, okay, good, very good, and extremely good, and then the numbers that would be representing that if that investment turned out in that way, and then of course our probabilities that need to add up then to 100%. Now, as we compare the two investments, what we want to get to is going to be that bottom line return, and then we can get our expected return. Clearly, the higher the better for the expected return, but then we also want to consider the amount of volatility or the amount of risk that might be involved, meaning that the amount that could be variations from what would be kind of like the mean, the expected value, the average here, and that's going to give us our amount of risk. And those are the two factors we typically want to take into consideration most with these kind of calculations. So with the first project, notice we broke them out this time into 5 categories. There's no set amount of categories. Usually it's between like 1 and 10. Usually like 1 and 6 or something like that is closer to it. And we're going to base it basically based on prior periods possibly and what we think is going to happen in the future, and then try to pick up what returns we think are most likely to be happening in those categories. Then we assign the probability how likely we think those returns are going to be taking place. So we're going to say it goes from 600 to 650 to 800 to 950 to 1,000 if it's going from not so good to very good. Then we're going to assign the probabilities. In this case, the probabilities we assigned evenly, 2020, 20, 2020. And then the expected value is going to be the 600 times the 20% or 120, the 650 times the 20% or 130, the 800 times the 20% or 160, the 950 times the 20% or 190, the 1,000 times the 20%, the 200. That gives us an expected value of the $800. Option number 2 for the cash flows or our investments. This time we notice we have a different amount of categories. We have 4 categories. The 2 amounts of categories for our investments do not have to line up. They don't have to be the same. We're trying to think about the number of categories that would make most sense for us to break down our data in a way that we think is most applicable for that particular category so that we can get then to the expected value. Notice here we have 28 value. That should be expected value. That 28 is meaningless, so please disregard the 28 there. So we have the 650 at the not good, the okay 700, the good 800, and very good 900. We have now assigned the probabilities that are going to be different this time. This is something we just came up with. This is something that we gave our best guess on. This is one way to structure our thought process, that being the 40%, the 20%, the 10, and then the 30. So 650 times 40% is going to give us the 260, 700 times 20% gives us the 140, 800 times 10%, the 80, 900 times 30%, the 270. Adding that up, we got the expected value for the second one of the 750. So of these two, the first one would be better, right? We got the 800 versus the 750. So if we just look at the expected value, you would think that given this, spread of data that we had, the first option would be the best. Then we want to consider the amount of risk that would be involved as well. So now we want to go and say the second component is going to be the risk. We're back to investment 1 here. I won't recalculate it for us. There's the investment 1 we had before. That's the first one with the 2020 investment, the probabilities. Let's calculate our risk now. So we're going to go through this calculation. We have the returns, same returns up top. We want to calculate the expected value. That's what we just did. That's the $800. Then we're going to take the difference between the return, each return category, and the expected return or average or mean of the 800. So the 600 minus the 800 is the 200. 650 minus the 800 is the 150. These are negative 150, negative 200. And the 800 minus the 800 is 0. 950 minus the 800, 150. The 1000 minus the 800, 200. Then we're going to take those differences and square them. I'll just do one calculation in the trusty calculator so we can see how it's done there. Make sure you got the squared button if you're going to need to be squaring stuff on your trusty calculator. Going to take the negative 200 and square it. That's going to be the 40,000. 40,000. If we do the same thing for the negative 150, we get 22.5. For 0, we get 0. That one I can do in my head. That was amazing. 150 squared, we get the 22.5. And the 200 squared, we get the 40,000. Then we apply out the probabilities, 20, 20, 20, 20, 20. And that's going to be our probabilities to get our end result. The 40,000 times the 20% is 8,000. The 22.5 times the 20%, 4,500. The 0 times the 20%, 0. The 22.5 times the 20%, 4,500. And the 40,000 times the 20% gives us the 8,000. Adding up the outer column then gives us the 25,000. That's the variance. It's in squared units though, so typically we want the standard deviation. So we would typically take the square root of the variance, taking the 25,000 and then square rooting it. Square root is this button. There's the button I'm looking for. The 158.11. And then we're going to compare it to the mean, which is kind of like the average or the expected value. And dividing that's what we calculated up top, the 800, divided by 800 is going to give us then the coefficient of variation, the 0.1976. This is not very useful in and of itself if we only had one calculation, but when we compare it to the second one, then it can help us with our risk assessment. So we're going to go on down and say, well, let's do the second one here. And we already did this part, so that's our expected value. You will recall from when we calculated it a while ago was 750. Hopefully you recall that. And now we're going to go and do the second component here. So we got our values, the 650 to the 900. Expected value, which we calculated up top, is the 750. The difference then being the 650 minus the 750, negative 100, 700 minus 750, 50. And the 800 minus the 750 is 50. The 900 minus the 750 is 150. The first two being negative, second two being positive. Then we will square each of them. I'll do the first one once again just so we can check it out on the calculator. We've got the 10,000. Hold on a second. Calculator's bouncing around. It's got a life of its own, my calculator. It's running around. Negative, and then we're going to square it. So negative 100 squared is the 10,000. So we'll do that same process for the negative 50 squared. It's going to be the 2005, 50 squared, 2005, and 150 squared, 22.5. And then we're going to use our probabilities, which you'll recall are the 40, 20, 10, 30. So there's our 40, 20, 10, 30. 10,000 times 40%, 4,000. 2,500 times 20% is the 5,000. 2,500 times 10%, 250. 22,500 times 30%, 6,750. Adding up the outer column for the variance, we get to the 11,500, but those are squared units. So we typically take the standard deviation, that is. And so we're going to take then the 11500, and then we take the square root to give us the standard dev of the 107.24. Comparing that then to the expected value, which you could think of as the mean or average, divided by the 750. That 750 is what we calculated up top here. And there it is. We get the, what do we call it? The coefficient of variation, 0.1430 about. And you could represent that as a percent or a decimal. So now if we do our comparisons, you'll recall that we had then the 800 had the higher expected value for the investment 1 versus the 750 for the investment 2, and it has now a higher risk to it as well. So in that situation, the question would then be, is the higher expected value worth the added risk? And that's going to be the typical kind of situation. Remember that it doesn't necessarily always happen that way. And so it's good to work multiple problems just to realize that. It is, in other words, a lot of times people get the notion in their mind that added risk automatically means that there's higher possible, expected return. That's not always the case. You can increase the risk and not have a higher expected return. However, it is the case that when you're comparing two investments that are good investments, the higher risk on those types of investments could quite possibly result in a higher expected return. The point being, you don't want to be taking on more risk just to take on more risk, assuming that it's going to have a higher expected return. You want to make sure that if you are taking on more risk, it's because it actually does have a higher expected return, and that you measure it in that component. See if you're risk averse or non-risk averse. Or a common book question here would be asking whether someone be risk averse or not risk averse. And the one willing to take the chance for the higher return would be more able to deal with or want risk, whereas someone who is risk averse might choose the second option here. It also depends on where you are in terms of your total investment kind of portfolio, or where your business is investing in terms of what types of investments would fit well within the risk assessment of your entire portfolio of investments.